The proposed 20% tax on unrealized gains put forward by the US Department of Treasury's 2023 revenue proposal could potentially become a penalty for being successful, according to Shehan Chandrasekera, head of tax strategy at crypto tax software specialist CoinTracker. Voicing the concern shared by a significant part of the crypto industry, Chandrasekera decried the proposal as ridiculous, and explained that the levy introduces uncredited prepayment credits which can offset the actual capital gains tax that gets triggered once a taxpayer disposes of the assets. There are two types of assets, tradable assets and non-tradable assets, he said. For tradable assets, such as stocks and crypto, taxpayers are to use market data for their valuation. The proposal introduces fiscal regulations for so-called illiquid taxpayers, i.e., taxpayers who hold tradable assets which contribute to less than 20% of their net worth. Such taxpayers would be allowed to pay the 20% tax only on unrealized gains applicable to tradable assets, including crypto. But, there is a catch here, according to Chandrasekera. Under the proposal, taxpayers who are classified as illiquid may choose to include only unrealized gain and tradable assets in the calculation of their respective minimum tax liability. However, taxpayers making this election would be subject to a deferral charge upon, and to the extent of, the RIA. The deferral charge would not exceed 10% of unrealized gains, according to the draft. The Treasury also proposes to amend securities loan non-recognition rules to cover digital assets, provided they apply to loans of such actively traded assets. The department would have authority to determine when a digital asset is actively traded, and the authority to extend the rules to non-actively traded digital assets. The proposal also would provide authority to the Secretary to extend the securities loan non-recognition rules to other assets such as interest in publicly traded partnerships, according to the proposal. The latest development is part of efforts by the US Treasury to obtain more information on offshore crypto holdings. The government's 2023 budget proposal is designed to overhaul the rules on digital asset taxation and produce close to $11 billion in revenues by 2032. Under the plan, the Treasury's proposal is to be effective for taxable years beginning after December 31, 2022. Learn more. Reports that IRS won't tax staking rewards create legal confusion in US, UK. Taxman updates its own guidance. India confirms discriminatory tax rate for crypto investors after a scare. Spaniards won't have to declare their overseas crypto holdings this year. Time to legalize and tax spy.